Have you seen the USD lately? It's like it went on a crash diet, down over 8% this year. And if you're holding US stocks, your portfolio might also be feeling a little light, like kosong. But don't worry. In this video, we'll break down why the USD is crashing, why the SGD is flexing its muscles, and what smart Singapore investors like you can do now. Should you be buying more DBS, OCBC, UOB, and maybe even throw in some blue-chip REITs like CICT or Ascendas? Stay till the end, because I'll share what kind of portfolio could give you steady cash flow, and how to avoid getting burnt by currency swings. If you find this helpful, like this video so more Singaporeans can watch it, and subscribe to Wealth for You for more investing tips that actually make sense. Just a quick disclaimer. This video is for education and sharing only. It's not financial advice. Always do your own research or speak with a licensed financial advisor before making any investment decisions. Chapter 1. Why the USD is weak in 2025. The US dollar used to be the world's bodyguard. Strong, dependable, the one everyone trusted to protect their wealth during a crisis. But in 2025, it's more like that gym bro who flexes on Instagram but can't bench without a spotter. First came the Liberation Day tariffs. President Trump's move to slap duties on nearly every major trade partner. That shook up global trade and made investors nervous about what rules could change next. Then came the real kicker, the big beautiful bill, a massive tax and spend package that's expected to add over $3 trillion to America's debt. Analysts say this could put the U.S. on a path toward a full-blown debt spiral, with rising interest payments, bigger deficits, and fading investor confidence. Add in lingering inflation and a lack of fiscal discipline. And what do you get? A perfect storm that's crushed faith in the U.S. dollar. The greenback has now fallen over 8%, its worst performance since the 2008 financial crisis. So instead of being the safe haven it used to be, the USD is now more like a roller coaster with a broken seatbelt. And for Singapore investors holding US stocks, that dip is starting to feel very real. Chapter 2. Why the SGD is strengthening. Meanwhile, our trusty Sing dollar isn't just holding its ground. It's quietly flexing some serious muscle. It's up over 5% against the US dollar this year. And it's even one of the top-performing Asian currencies, second only to the Japanese yen. And investors around the world, they're noticing. Why? Because Singapore is like that quiet student in class who doesn't make a fuss but always tops the exam. We've got political stability, a world-class central bank, low public debt, and no wild U-turns in policy. Just steady, disciplined governance, with time for a copy break in between. When the world gets messy, with tariff wars, rising U.S. debt, and shaky global confidence in the U.S. dollar, investors look for places they can trust. And Singapore? We're often one of the first names on that short list. In fact, even though MAS eased its monetary policy slightly in January and again in April 2025 to support the economy amid trade tensions and softening inflation, the Sing dollar has stayed strong, thanks to Singapore's status as a regional safe haven and its exchange rate system, which manages the SGD against a basket of currencies. This helps keep things stable and continues to attract global investor inflows even as policy loosens. That's why we're seeing more money flow into Singapore dollar assets, from bank stocks to blue-chip REITs. To some, Singapore might look boring, but to investors, it's beautifully predictable. And right now, that's exactly what people are paying for. Chapter 3. What does this mean for Singapore investors? If you're a Singapore investor holding US stocks, here's the catch. Your gains might look good in USD, but when you convert back to SGD, you could lose a big chunk of it. Let's say you bought into an S&P 500 ETF in January 2025. Good choice. It goes up 5% by year-end. You feel shock, right? But wait. Over the same period, the USD drops another 5% against the Sing dollar. So when you convert your gains back to SGD, guess what? Your returns are wiped out. You break even. It's like climbing the mountain and sliding back down at the summit. Now imagine if the USD drops even more next year, maybe another 5% or more. You could actually lose money in SGD terms, even if your US stocks keep going up. That's why it's so important for Singapore investors to not just look at stock performance in USD, but also factor in foreign exchange risk. Chapter 4. Is it time to look at Singapore stocks? This is why more Singapore investors are turning their attention back home to strong, income-paying local stocks like DBS, OCBC, and UOB. These banks aren't just stable. They're like that reliable uncle who always gives ong bao on time. Over the years, rain or shine, they've been consistently paying solid dividends, and in 2025, they're still going strong. Yes, interest rates are starting to come down a bit this year, so banks aren't enjoying the same margin boost as they did in 2023 and 2024. But hey, they're still profitable, and many are making more from other areas like wealth management. And here's the big plus. Your dividends are paid in SGD, no currency roller coaster, no conversion drama. Just dependable income in a currency you actually use. While the US stock market might offer growth, especially in tech, Singapore banks offer something a little more steady, reliable cash flow in your own currency. And that matters even more when the USD is heading south. So if you're tired of FX losses quietly eating into your returns, maybe it's time to come home. Where the kopi is strong, the banks are stronger, and your dividends are paid in Sing dollars. Chapter 5. Don't forget blue chip REITs. And it's not just the banks doing the heavy lifting. Let's talk about Singapore REITs, or S-REITs. Because honestly, who doesn't love passive income that drops into your account every quarter like clockwork? These aren't just any REITs. We're talking about the big boys, backed by high-quality, income-producing properties you probably walk past all the time. Here are some familiar heavyweights. CapitaLand Integrated Commercial Trust, or CICT, owns iconic spots like Plaza Singapura and Raffles City, plus top-grade offices in the CBD. High footfall, high rental income, very solid. Ascendas REIT. Think business parks, industrial hubs, and even data centers across Singapore and overseas. It's one of the biggest REITs here and helps power the engine room of our economy. Mapletree Logistics Trust, or MLT, owns logistics warehouses across Asia, riding the wave of e-commerce and supply chain demand. While others sell the products, MLT owns the space that stores and moves them. What makes these REITs stand out? They generate recurring rental income, and they're required by law to distribute at least 90% of their earnings. So you're not betting on hype. You're getting paid from actual rental cash flow. Even when markets get moody, these REITs give your portfolio a steady heartbeat of income, which is especially comforting when everything else is swinging up and down. Yes, some of these REITs have overseas properties, which means there's some FX exposure at the REIT level. But for you as an investor, the payout still comes in SGD. That means no extra conversion work, no surprise forex losses when the USD drops. So if you want stable, Sing dollar income, and a little more peace of mind, S-REITs like CICT, Ascendas, and MLT might be exactly what your portfolio needs. Chapter 6. Strategy going forward. Build cash flow, not just growth. Look, we all love growth stocks. They're exciting, futuristic, and full of potential. But in times like these, when the USD is sliding, markets are jittery, and the global economy feels a bit like a roller coaster. Maybe it's not such a bad idea to be a little boring, because boring can be beautiful, especially when you're building a cash flow-rich portfolio that pays you even while you sleep. That means focusing on SGD-denominated dividend stocks and blue-chip REITs that consistently generate income, whether the market is up, down, or sideways. Think DBS, OCBC, UOB, CICT, Ascendas, Mapletree Logistics. These are companies with track records, real assets, strong governance, and payouts you can plan your COPI budget around. Of course, if you're still hungry for growth, go ahead. Sprinkle in some overseas exposure, maybe US tech or China innovation. But let that be the satellite, not the anchor. Your core portfolio should be strong, stable, and Singaporean. Built to weather currency swings, provide steady returns, and help you grow your wealth without losing sleep. In the long run, it's not just about how much your portfolio can grow, but how sustainably it pays you along the way. Final thoughts. Let's wrap this up. So, let's recap. The USD is falling. The SGD is strong, and Singapore is looking more attractive than ever for investors who want stability, income, and peace of mind. If you're holding US stocks, it's a good time to check how much your gains are being eaten up by the exchange rate. It might hurt a bit, but it's better to know now than later. If you're looking for consistency and cash flow, Singapore's dividend heroes, DBS, OCBC, UOB, and solid REITs like CICT, Ascendas, and Mapletree Logistics could give your portfolio that dependable boost. Because at the end of the day, it's not just about being rich, it's about being cash flow rich. The kind of rich that pays you while you sleep. If you learned something new or found this video helpful, do me a favor. Click that like button so the YouTube algorithm shows this to more Singaporeans who need to hear it. Subscribe to Wealth for You for more easy-to-understand investing content that actually makes sense. And hit the notification bell so you never miss an update. Thanks for watching, and until next time, may your dividends be steady, your returns be strong, and your COPI always gao.